Well, so excited to have everyone here this afternoon. I want to welcome everyone to our last session in the series on financial sustainability. For the month of March, we've been focusing on how to help your business in a financial capacity. This is the workshop that I've been waiting for. I do want to note that congratulations to our chapter, the SCORE Minnesota chapter, for receiving the 2020 Chapter of Excellence Award. We're so proud of our volunteers who make this possible. And we love bringing you quality educational programming to help folks in this month having financial sustainability. So if you don't know anything about SCORE, here's just a little bit of information for you. We are a nationwide organization. We are part of the SBA. We have over 300 chapters nationwide, over 10,000 volunteers. And SCORE in Minnesota is a very robust chapter. We have a lot of folks that retire here. So we have a wealth of human capital that are here at your disposal to help you with any aspect of research and planning and pre-startup, starting up a business and opening a business, or whether you're looking at growing or scaling your business. We have folks that can help you through each of those steps. And then we also actually have an exit strategy team. So if you're thinking about selling your business or thinking of exiting your business, that's the group that can really help you in making that something that's super successful for you. So if you want help with any of these pieces of your business, simply go to our website and you can learn more about requesting a mentor. You can also find the various workshops and webinar events that we do, as well as other resource libraries. So our website has a lot of information. It's a great way to engage with us. And you'll hear us talking about the mentoring piece throughout the presentation. Obviously, we couldn't be here without our sponsors, so we thank them each and every time for their support and helping to provide you for free these types of programs, as well as free mentoring. So thanks to our sponsors. Without further ado, I am going to introduce our speaker today. This seminar I have been waiting for the entire month of March. Boris brings such a wealth of knowledge and experience to our chapter. He is a Silicon Valley and Seattle guy who really has a lot of tech experience, and also has worked with a bunch of startups and knows venture capital, angel funding, crowdsourcing, any and all types of funding that you can acquire for your business. And actually coming up in the month of April, he'll be doing a couple of focused sessions on that. So Boris, welcome. We are so happy to have you. Truly appreciate your volunteering for the organization and joining us today.
Thanks, Paul. So as Paul mentioned, I come from Silicon Valley, but I've spent some time here in Florida now, and I am a SCORE mentor. And when I meet one of my SCORE clients, one of the main issues they ask me when they have a great idea to start a business or they have a great idea how to expand their business is how to get funding. How to get funding for it, because without money, a lot of ideas just die. So today we're going to talk about all the various sources of funding, because I think there's a lot out there, and I think there's a lot that people don't realize. I think people think of, banks or investors, but there's a lot of options. So we'll go through them. This is a very big topic, and as Paula said, we're gonna spend some time in April on drilling in on some of these. So I'm just gonna give you a broad overview, and if you're interested in learning more, you're welcome to join our webinars in April. Also, you can have a SCORE mentor who'll be happy to help you and walk you through some of these. And also, I'll give you some links here and pointers of where to look for more information. So the first thing you need to do when you're thinking about, how to fund your business, whether you're starting or growing, is to assess where you are now and where you want to go. So first of all, you should understand any kind of loans you get are going to be based at least partially on your own personal credit, and any loan or investment you get, you're gonna have to participate. Some of your money is gonna have to be involved. So the first thing you do is assess your own personal situation. How much money do you have? How much money do you have access to? How much in debt are you already? Do you have a house? Do you have other assets that could be used as collateral? all those kind of things. So where are you personally? Make sure you're in a good place. And then, well, where are you going? So, how much money do you need? And this is something where people struggle a lot. Usually they underestimate or they just don't know. This is something we work a lot with our clients, is to sit down and realize a budget. So if you're starting a business, or if you're planning to open another store or expand, what really will it take? So you have to be honest and sit down and think of all the possible expenses. If you're opening a new restaurant, how much will it cost to, to put a security deposit in the lease, all the equipment, all the supplies, and some money, for the first few months when you may be losing money before you turn profitable, right? So take all that and add another, 20% at least, because there's always unexpected, expenses. And the last thing you want to do is spend all this time raising money and then run out of money right as you're starting your business. And then lastly, this kind of involves your personal situation. What's your credit worthiness? And we're going to talk about this, but not just your own personal like FICO score, but even your business score. If you've been in business, you probably have a business credit score. So where are you credit wise? Because this is something very important that many people will look at. So all those things you should consider as we talk about this. So here's a list of many of the ways to raise money. You can see it's a pretty big list, but we're going to go through this. And the first question you should ask before you dig too much in this is the type of funding you want. And the two main types are debt or equity. So debt, as you can imagine, is a loan, whether it comes from a bank or other kind of institutions, or whether it's from your friends or family or on your personal house. But it's a loan. It has to be repaid. So the good part of it is you're not giving up any equity. So you still own all of your company. You have no investors. No one's going to tell you what to do. The downside is you're in debt and you owe money. So if business fails, you have any troubles, and you have a hard time paying it back, you're on the hook for the money personally. Equity, on the other hand, are investors and other people that invest money in your business. They're going to take a part of your business. So you're going to have investors who may have different ideas than you, so you have to be careful. And that could be the risk factor. The upside is that you don't owe anything and there's no debt. So if the business doesn't work out, everyone loses their investment, but you don't owe anyone anything. So each one has its positives and negatives, and you should consider what's best for your situation and what you have access to. So on the debt side, we have bank loans. We have bank loans that are guaranteed by the SBA. We'll talk about that. There are other kind of lenders that aren't traditional, banks that you can tap into. And then there's your personal side. You can borrow. You can take money out of your credit cards. You can borrow against your house, or even against your retirement account. You can get a personal loan. You can borrow from friends and family. So all those are personal kind of debt that help you to invest in your business. There's also from the banking side, there's also equipment loans where you're borrowing against equipment. We'll talk about. On the equity side, there's investors, and that could be also your friends and family, other people. Could be angel investors, folks like me who like to invest in startups that have a potential to grow quickly. We'll talk about that. And it could be just people in the neighborhood or people who want to invest in your business and want to be partners. And then there's stuff that's not really equity or debt. We'll talk about it, but there's grants and awards, which is money for free, where you don't give up anything and you're not in debt. There's crowdfunding where you may owe them a product or something. So there's a few things in between. So let's kind of look at these things a little more deeply and see the pros and cons. So bank loan, I'm sure all of you are familiar with banks. We'll talk a little more about this, but you want to go to a bank where you have a banking relationship. The nice thing is they can lend a lot of money, up to a few $1 million, right? So they should be able to cover any amount that you need. The nice thing is, again, it's a large loan, and if you have a good relationship, it's great. Now, usually the bank loans only kick in after you've been in business for 2 years or more. So this is more suitable for those of you who already have a company, who have established a relationship with a bank, have a business credit score, et cetera, can provide tax returns, et cetera. So people go to banks once they're already in business. They have a track record of bringing in revenue and can lend from the bank. The downside, of course, is that there's an application process and you're in debt and you have to personally guarantee the loan. etc. And then SBA is really still a bank loan. You still go to the same bank we just talked about. Just if you can't get the loan directly from the bank based on your credit, SBA can help. They guarantee a portion of the loan, usually a large portion, and so they can make the loan easier. And the upside, of course, is that if you can't get the loan, if you don't qualify directly with the bank, SBA can help. The downside is a lot more paperwork involved and more process, and we'll talk about that later. And the rates are a little higher too. So if you can get a bank loan directly, you should get it. If not, SBA can help you. There are nonprofit lenders, and we'll go into these are like credit unions and development councils, and the dollar amounts are smaller. The nice thing is that they're more lenient because they're they're trying to help you and they're not trying to make a profit. The downside, the loan amounts are usually a lot smaller. There's the personal stuff I mentioned. Credit cards I think are pretty well known. You can use your credit cards. Of course, the downside is the small amounts and you're on the hook for the money. Interest rates are very high, so it's not the ideal way to do it. But if you have credit cards and there's no other way, then it's fast and quick. There's your house. If you have a house, whether it's your personal home or a second home, investment, you can borrow against it. If you don't have a big loan already, you can either get a second mortgage or a HELOC, which is just an equity line. Usually up to 80% of your house. So upside is that you have the collateral. It should be pretty easy if you have a good credit score. Downside again is you could lose your house if your business fails to produce enough income to repay the loan. You can also borrow against or invest with your retirement account. This works for like IRA or 401k. These are smaller amounts, but the upside is that there's no approval process from bank. It's up to you. You're approving yourself. The downside, there's complexity. You have to work wherever your retirement account is. You have to work with them on paperwork, and then you risk your retirement if it fails. So on this next slide, we'll go into some more of these. Personal loans. You can go to the bank and ask for personal loan. These are small amounts again, but these are based on your personal credit. So if you have a good credit, banks will usually give you some amount like $10,000-$20,000 uncollateralized. Again, the risk is that if your business doesn't work out, you're on the hook for the money. Friends and family, hopefully you have some friends and family that are willing to lend you some money. So again, obviously the upside is that there's no lengthy approval process. The downside is if the business doesn't work out, you're gonna owe your family or friends a lot of money. Equipment financing, if this works, if you're buying heavy equipment or expensive equipment, usually either the store where you're buying it will extend you credit over several years, or a bank will give you a line of credit against the equipment so that you can buy it, and it can be up to 80%, sometimes 100% of the equipment cost. Upside is that there's collateral, so banks are more likely to lend against it. The downside, obviously, they could repossess the equipment if you can't repay the loan, and the rates are somewhat higher in some cases. It can only be used for the equipment itself. So this only works out if you have some big equipment. You're not going to do this for a blender or something. Crowdfunding, I'll talk about more later. It's a more recent innovation where large crowds of people. This isn't a bank or institution. These are just regular people who get excited about your product, and they want to chip in to help you build that product. So if you have that kind of product, gets people excited, this could be interesting for you. The upside is that it's usually not debt or equity. It's mostly free money. You just owe people your first product. The downside, it has to to fit the audience. You have to spend a lot of time in marketing and getting people excited and figure out your demographic. Angel investing is basically venture capital. So people experienced in the field who come from a background where they've been in business and have assets now to invest, and they want to support new entrepreneurs, or they want to make a lot of money. They're going to invest in stuff that grows really fast. What they're looking for something that eventually will be picked up by venture capitalists, and they're the first investors. They want the next Uber or whatever. So if your product is in that category where it has a chance to grow, grow quickly, this is something you should look into. This is equity financing, so you give up a part of your company to angel investors, and eventually you'll give up even more of your company to further venture capitalists, but this is the way to grow your business without any debt. And so it's a way to grow your business very quickly. Angels can chip in hundreds of thousands of dollars and then get you to the next round. The upside is that they don't just provide money. One of the reasons they're called angels is because they also add their expertise, right? A lot of people they come from the industry you may be involved in, or they've been through this before, and they can help guide you, to success. So you get money and you get advice. The downside, I guess, is that you're giving up their company, and they may have other ideas than you. So you have to make sure you can work with them. And then there's grants and awards, and if you can get them, it's free money. So the amounts are usually small. Usually it's like 10, 20,000, but in some cases it can be bigger. Obviously, if everybody wants free money, downside there's a lot of them, and obviously everybody wants the free money, so you have a lot of competition. So it's a lot of work to kind of to find the grant that fits you and to apply for all these and to win one of these. But it's free money. So those are the the main source of the funding. I can't go into detail on all of them because there's just a lot here, and some of them are pretty obvious. But I want to go into a few of these, that are important and give you a little better understanding. And like I said, April does give you even more information. So bank loan, all of you are familiar with banks, but let's go into what it really entails, because I'm sure a lot of you haven't actually gone to a bank on the business side. So the first thing any bank will recommend is that you build a relationship. So you can just walk into a Bank of America and say, hey, I want a business loan, but they don't know you. And unlike the personal side where they're obligated to serve every customer that walks in if they qualify, there are legal requirements. For business, it's not like that. For business, they're building relationships, long-term relationships. So they want to invest in companies that do business with them. And so you're much more likely to get a loan, qualify for a loan, if you already have a relationship with the bank. So the way to establish a relationship is if you're already in business. And like I said, a bank loan usually only works if you've been in business for 2 years or more. So this is not really useful to you if you're just starting off a business, and but if you do have a business, establish a relationship. Pick a bank you like, or explore. But once you have a bank you like, make sure your business checking account is with them. You do your checking with them. You can get a credit card with them, business credit card. You can have a line of credit. Whatever you can establish with them, really helps build the relationship, and they'll want to do business with you. Next thing is build your business credit score. So many of you probably don't know, but just like you as a person have a FICO score, and everyone talks about your credit score when you apply for a mortgage. Businesses do have a credit score, and these are tracked by some of the same agencies that track your personal side. And the way to help establish a business credit score, as you can imagine, same way as personal. Again, open a credit card, a credit line, an equipment line, anything you can, to develop a credit score, to show that you can repay your loans on a monthly basis on time. So generally they look for 3 trade lines. So 3 of these, whether it's 3 credit cards or a credit card and 2 loans, etc. So that's the ideal situation. So ideally you're doing this with one bank and you're building your credit score. So the bank really gets to know you and you have a track record of paying back your loans. That'll put you in the best shape. Like I said, 2+ years, they're going to look for tax returns at least 2 years, to see how you're doing, to see that you're consistently bringing in revenue and have cash flow to repay the loans. You're going to have to guarantee these loans, until you have a massive corporations. They're always going to ask you to guarantee the loan. So you are going to be on the hook personally for these loans. So they're going to look at your business, credit and your cash flow, but at the end of the day, they're going to ask you to personally guarantee these loans, meaning you're in the hook if the business fails to pay. And the things they're going to ask you for, just so you prepare yourself, is a resume, because they want to see that your professional past experience makes you qualified to run this business, and you actually know what you're doing, right? You haven't just gotten lucky for 2 years. So they do want to see your resume in the past. They're going to want to see a business plan. This is probably one of the hardest things of going to a bank, is you got to have an official business plan. You can't just wing it on a piece of paper. So you're going to build a business plan, and at SCORE we can help you with that. You have to have a 3-year projection. So, it may not be accurate, but you got to show the bank that you understand how your business is going to function the next 3 years, because they want to see that you can pay back the loan. You should be using QuickBooks or some accounting system. Hopefully you have an accountant or CPA, because they're going to ask you for the metrics, and you really have to understand your data, right? So you have to show your usual, your profit and loss statement, your balance sheet. You have to understand your cash flow. A lot of what they use is looking at the cash flow. And if you're doing a construction project, engineering, blueprints, things like that, right? In general, in general, just to give you an idea, I talked to a banker yesterday. They're giving out, in terms of a credit line, if you just want working capital, they're giving out 15 to 20% of your gross yearly revenue right now is a credit line. So if you're a little store and you bring in $100,000 a year, $15,000 to $20,000 they'll give you as a credit line, just to give you an idea. So they're not going to give you a huge loan in a small business, right? Now, if you have trouble qualifying, directly to your bank, what your bank will usually recommend, and they'll do this for you because they want you to get a loan, they get commission, right? Is they'll recommend involving the SBA and getting an SBA loan. And what this is the same bank loan. It's going to come from the same bank. They all work with SBA. They all, and it's, money is money, but they're going to use the SBA because the SBA will provide them some cushion, some guarantees. This is just like on the personal side, when you get a mortgage, if your mortgage is conforming, it's guaranteed by Fannie and Freddie Mae, and that's what keeps the rates down. In this case, actually reverse. If you can get a bank loan, you should get it because the rates are actually lower without involving the SBA. Once the SBA gets involved, the rates go up. But they are providing a service. They're helping you get the loan. So the most common SBA loans is 7A. And again, this will be presented as a whole webinar in April. So I'm just gonna briefly touch upon this. But the most common is 7A, and that can be used for almost anything, whether you're buying some fixed asset or whether you just want some working capital to hold you over or whatever. They come in fixed and variable forms. Right now, I've heard most banks are doing variable rates. The rates I've heard right now are somewhere between 4, 5, 6%, so a little bit higher than what banks will do directly. And they're expecting both personal and business collateral. So with all these loans, I should mention, collateral makes it a lot easier. So if your business has a building you own or some big equipment you own, all the desks in the office, computers, whatever, all that is collateral. So the bank knows if you don't pay back the loan, they can just take that and resell it. So the money is safe. So the more collateral you have, the easier it is to get the loan and the higher loan amount, right? So they're going to ask for 7A. They're going to want personal collateral as well. So your house or whatever you have. You're usually on the hook for a portion of the money, but not all of it. Something like I think like 15% of it that you personally have to repay if the loan goes bad. And SBA will protect most of the rest of this. The length of the loan can be between 7 and 25 years. It just depends on what you're getting. Whether it's to buy a building, real estate can be longer. If it's just working capital, it will be less. And the down payment will range from 10 to 25%. If it's a safe loan, something collateralized, will be like 10%. So all you have to do is put down 10% of your own money, and the rest comes to the bank. If it's more risky, it can be up to 25%. This can also be used for acquisition. If you're buying a business from someone else, it can be used for a portion of that. For construction, real estate, especially in areas they're trying to promote, a 504 can be more appropriate. I talked to one banker yesterday, and they said they usually, if the loan is over $1 million, they'll recommend a 504 just because it's cheaper. One of the main advantages, a portion of the loan has a lower rate just because of who it comes from. So the advantage is pricing in many cases. It is a longer fixed term, which can convert to a variable after a certain amount of time. So the rates and terms are a little different. And like I said, it's mostly used in real estate construction, buying or building a building or structure. And the advantage, like I said, it can be a little cheaper. The disadvantage is that it is very complicated. And again, the bank will work in this, but the loan is coming from, the money is coming from 3 different places in this case. And so it's not the SBA guarantees the loan, it says they bring in another agency called the CDC, which we'll talk about later. And so you're required to put up 10% of the money. Like, for example, if you're buying a building, you put up 10% money, which is great. Your down payment pretty small. The bank puts up 50% of the money, and they're kind of as like a first mortgage. So they're first in line to get repaid. So that's why they're happier, because they're not on the hook for the whole loan. And then 40% is provided by this organization called the CDC, which we'll talk about later. So the structure is all different, and like I said, it's used mostly in real estate. So those are the two main kinds of SBA loans or guarantees. Now, nonprofit lenders are still, lenders. You still, you go, you apply, you get money, but they're not trying to make a profit. So the rates can be lower, the terms can be different, could be easier to qualify. The one you're probably most familiar with is a credit union, right? All of you probably heard of credit union. Is just a bank, but they're nonprofit, and they're usually there to serve a community. There's credit unions for teachers, for military people, for one company. So if you belong to a credit union or you qualify for a credit union, you can check with them, and they're still going to have a loan process, still need a business plan, but their rates may be a little bit lower because they don't need to make a profit, right? Other ones are a little more focused on certain areas, whether they're trying to promote a low-income community or disadvantaged people. So if you're in a minority group or you live in the minority area, etc., it may be easier to come to these. The loan amounts are smaller, but they can help you a lot. Not to get confused in all these acronyms, there's CDFIs, which are, again, they focus on disadvantaged borrowers and disadvantaged communities. That's where they play. There's CDCs, again, which we'll talk about. They're also nonprofit organizations, and they're trying to promote housing and business development. So and they participate in some of these SBA loans, like we said. And there's going to be a speaker for one of these in April, so you'll learn a lot more about this. There's an EDC, which there's one in Manatee County, there's one in Sarasota County, and I'll have links to these in my slides. You can see, but they're trying to promote business development in their community, and they're trying to grow economic activity, right? So they could provide you with grants and loans, etc. So you should always look at them and see what they have to offer if you qualify. And then there's micro lending, which is another new innovation in fintech. A lot of these are nonprofits. They give very small loans. That's why it's called micro. But they're trying to help a lot of small entrepreneurs get started. So if you qualify, it's a great source of money. It's not going to be a lot, but $10,000, $20,000, $50,000. And then you'll get these slides. So I provided some information about some of these organizations. You can research on your own. And on the next slide also. So you can see some of these organizations, and you feel free to contact them, and you'll have to do your research and see where you qualify. Crowdfunding. So many of you probably have heard about this on the news, but but don't know much about this, and that's because this is not where most people raise money, especially for local businesses. But what is it? It's a platform where you can connect with a large amount of consumers and show off what you're doing, what you're building, and these people get excited and they want to chip in and support something interesting that they're interested in, and they may get the first product, right? There are different types. In some cases, they're just donating money. In some cases, there's some equity opportunity, but in most cases, it's kind of we call rewards based, meaning they chip in some money and they get a reward, like they get the first product that you release. So this only applies if you have something really that's going to excite a lot of people, right? Because they're not going to chip in a lot of money. This isn't some big investors. So for example, if you're coming up with a new clothing product, or a new little rocket ship for kids, or frog eggs in space, or whatever, something you can do and raise some money that way. The nice thing is you're not really borrowing money. You're not going into debt. Usually you're not giving up any of your company. Basically, it's almost free money, except you owe them a product, right? So they're kind of buying a product in advance and giving you this money because they really want to see you build that product, right? So I've listed here, all the various major crowdfunding platforms. Probably the biggest one you've heard of is Kickstarter, for tech products, etc., things like that. But you can look through these and see if they make sense for you. And then there's grants. Like I said, it's free. It's free money. The downside, it's never easy to get free money. So they come from all kinds of places. They come from the government. Even the SBA has a competition basically, and the winner gets $70,000 for the best business idea in a certain category. You can look at the government database. There's a ton of them on the federal side. There are state grants, even grants in communities, etc. There's also ones for businesses. AT&T has a program. FedEx, lending to any big corporation. You can look up what kind of grants they're offering. These amounts are 25, 50,000. That's usually the range. Some cases it can be higher, like here I've listed ones at 100,000, and some of them are targeted, towards the best business ideas. Some of them are towards minorities or some groups that these businesses are trying to promote. So it's a lot of work to reach out to all of them, but if you feel you qualify and you're willing to to hustle, it's free money. And then here's a list of some resources. So I'm sure you're all excited for free money. So how can you be successful in raising free money, right? So the key to success is really you have to be really detail oriented, and you have to have a lot of time on your hands, right? Because you're gonna have to go through it. It's not like you apply for one grant and you'll probably get it. The odds are pretty low, right? So you have to have a good story, be able to explain these. These people are giving you free money, so you got to explain them why you deserve it. So you have to have a good story, and you have to understand your business. You have to explain how well you're doing already if you're already in business, right? And the story is not the same for every application. So unfortunately, you got to tailor make. If you remember the days when you applied to college and wrote your essays and did all applications, and you enjoyed that process, you're really gonna enjoy this. So again, you have to be detail oriented. So they all have deadlines. Paul, if you can go up and back up. So they all have deadlines, right? And they're different, and sometimes there are multiple deadlines, and they all have different criteria on what the requirements are. So you really gotta you really have to pay attention. Each one's gonna be different, so you can't just blast your application to everyone. You should know the grant numbers that they all have different dollar amounts. So make sure you're applying this something that makes sense for you. And make sure you understand how many they're offering, how many people apply. So it's a game of odds, right? So you want to apply the ones where you're more likely to get in, and not the ones where there's one award and a million people apply, right? You should do your homework and see who's won these awards in the past and what it took and what their application was like. You may be able to even reach out to some of these organizations. And again, don't just focus on one because your odds are low. You got to apply to as many as you can. And if you have the money, you can hire a grant writer if you feel like it's going to justify the cost. They can be costly, but they can do all this work for you, and they know better what's a good fit. So that's grants. So we've gone over some of them. I kind of try to highlight some of the pros and cons and how it works. But what's going to improve your chances overall in these things? Let's just do a final review, right? So for banks, right? As we said, right? It's all about your business, your metrics, your ability to generate cash flow. They're going to look at all that. And so, the better condition your business is, the better your credit scores, the lower your debt is, you're more likely to succeed. And I've kind of explained how to prepare for all that. Credit cards, home equity, personal, also on personal side. I think it's pretty clear, right? You've got to maintain a good credit score. The higher your credit score, the more likely you are to get a loan. I should mention, people have gotten loans from banks, both personal and business, with, they, even on business side, business loans, they're going to ask you for your personal credit score. Over 600, they'll start to consider you. Over 700, you're in pretty strong shape. The 600s are kind of your borderline. If everything else is great, you can get in, but over 700 is you're in much better shape. So for credit cards, home stuff and personal, your credit score, and then your debt, how much debt you already have. So if you're already hugely in debt, it's going to be really hard. If you don't have much debt, banks are much more likely to give you a loan. On houses, they're going to look for, 80, 90% of your house. And these other ones, and even on the home, they're also going to look at the cash flow. So how much income are you bringing in, whether it's your business or your job, and make sure that less than half that money is being used to repay your other loans, right? Family and friends, well, you should maintain family and friends. Be nice to them at this time. We try to discourage you from pressuring these people. These are personal relationships. From lending you money. Obviously, you don't want to get in a situation where we'll feel under the gun. But you want to be able to explain your business, even though it's a friend or family. You really want to make them feel comfortable. Explain your business, being able to rationalize how you're going to be successful, so they feel like they're going to get their money back, or if they're investing, they're going to make money on this, right? So on this slide, we'll go over the rest of them. Crowdfunding, as I mentioned, right? You really have to have a compelling story. It has to be really simple. It's not a bank. They're not going to read a 40-page business plan. These are people that get excited. They want to chip in some money. So they're going to flip through the different products, different companies, and something will catch their eye. So you want to catch their eye really quickly, right? So it's be compelling. You have to work on marketing. You really have to understand who you're targeting. So if you're building a brand new shirt for female millennials, then you have to know that's who you're targeting. If you're building a new toy, who are the parents that are going to get excited by that, right? So you have to know your demographic. You don't want to just blast everyone in America, right? So know your audience, have a compelling story, be able to quickly convey it, right? Angel investing and just venture capital in general, you're going to have to have a pitch deck. And again, I'll go over this more in April, but it's no longer a business plan. You have to have a pitch deck, and there you're really going to have to convince them that you have a product or service that can be easily differentiated from the competition. You have a plan to go to market, how you're going to launch this, how you're going to get people to find you and your product, how long the money will last. Make sure you have a good story there about the whole business and how you're going to roll it out. And practice your presentation. Angel investors, you pitch them over and over to different ones. So, role play with a score, with your score mentor or with your friends. And then, grants and awards. Like I said, you have to have a lot of energy, a lot of time, but, make sure you understand the eligibility and make sure you fit the eligibility of the grants you're interested in, and then, you just have to go, all out on that. So that's kind of, the ways you can succeed in this.
Boris, that was really awesome. And just a tag on to this, obviously with COVID, with the PPP funding and other grants and loans that are forgivable, we're doing workshops on that. And we do have a workshop that's going to be coming up on the updates for the PPP. So if folks are interested in that, that will be coming up as well. So wanted to just chat with you a little bit about this, Boris, and your experience. Obviously you've watched a lot of startups go through probably every single funding process that's there. What do you think is most successful for startup businesses to be looking at in terms of funding?
Well, this is the thing, there's not one size fits all. If you already, if it depends on what your business is making or serving. So if you're in the local community and you're starting a new hair salon or restaurant, it's more of a traditional funding model, which means if you already have a business, work with your bank. I mean, banks are really good for established businesses. And if you have something that you feel is really innovative and it's more than just in your local community, you want to eventually to sell across the country, whether it's a new part for a lawnmower or whether it's a new, toy for kids or something that's applicable, to the country or the world, then you should look at investors. And, I mean, investors can be anyone right? Anyone who has the money to invest. So, there are different routes. Right now for COVID, it's a little bit harder investments, a little bit easier. SBA has more, programs, PPP, etc. But in general, it really depends on your personal situation. So I'd say if you can get a loan, I personally think that's one of the better options because you're not giving up anything.
Sure.
But if you have something exciting, try to get investors.
hmm And then a question came in on how to find angel investors. And we are going to be doing a whole entire workshop on that. But if you could respond to that question and maybe provide a couple of resources there.
Yeah, so it's a tricky question because everyone can be an angel. So all of you, probably know angel investors, meaning there's, in general, I mean, there's SEC rules of accredited investor. So it's basically a wealthy individual who either earns enough money to qualify or has enough assets in the bank, that can absorb a loss. So these are doctors and lawyers and financial advisors, anyone who has a high-paying either job or has made some money in their own business, has sold their business, really is an angel investor. There's nothing else that qualifies them. Anyone can be an angel. You could be an angel. So the people and a lot of it is just asking around, and that's why we refer to it as this round of funding as friends and family, because you really have to work your personal network. I mean, the first investments you get when you're just starting out and no one knows you are probably going to be by people who trust you, and those people are people who know you, right? Not some strangers. There's also angel organizations. There are groups. There's one in Sarasota, and I'm going to be presenting this in April. But there's one in Sarasota. There's a bunch of them in Tampa, Orlando, and you can always Google for angel clubs, angel investor clubs. They work together just to make it easier, and they have monthly meetings. You apply to them, and if they choose you, you can present to them. Every month they have a few founders who will pitch to them, and anyone who's interested can follow up with invest, right? So you want to reach out, and some have focuses. So if you're a minority or a woman, etc., their angel groups, support those kind of founders. But in general, they're everyone.
So one of the things that I do want to make a note of is you've provided here, Boris, the contacts for various banks in the community. And for folks that are with us, we have relationships with these banks. Many of them are sponsors for SCORE. So if you have a business idea and you come to SCORE with that idea, we can definitely provide you with those introductions to those banks. And as you mentioned, Boris, developing these relationships is pretty critical, when it comes to credit and loans, et cetera. And I think, you shared with me a story about someone, they had a relationship with a bank, and, that relationship can go a long way.
Yeah, I definitely encourage people, if you plan to be in business for a long time, you're going to need a bank. Every time you try to grow, or if you're having some difficulties, banks are just really important. And investors can be finicky. They can come and go, but a bank's always going to be around. So if you have a relationship with a bank, a long-term relationship, they're there to kind of help you and work with you. And for example, yesterday, just to prepare for this, I called up Fifth Third, which is over here, and I happen to have a relationship with them. And they got on the phone with me and explained their programs and everything. And if I called up Bank of America or Wells Fargo, I don't have a relationship there, so I wouldn't even know who to talk to. So you should have a banker at your bank and always be updating them on your business, and they can really help you.
And I think it's important to note that, you need to have a business bank account, not just a personal bank account, and keeping kind of the separation of church and state is something, word to the wise.
Yeah, this is something the banks will counsel you on. Anytime you talk to a bank, they're really gonna get worried if they can't track your cash flow. Meaning, if you're paying for your milk with your business money, or if you're buying a tractor off your personal checking account, it really gets hard for the bank to follow this, and for even the IRS and everything. So it's for liability too. So any accountant will tell you, you really have to keep a firewall. You have your business checking, you have your personal checking, and those are two separate things. And it can be hard if if you're a small business. Obviously, you're running around and you're buying groceries and business equipment on the same trip, but it really will help you in the long term if you get into the habit of paying for the right things with the right credit card and the right bank account. Otherwise,
Absolutely.
no one knows what's going on.
It makes it so much easier from an accounting standpoint and closing out the year. You had some other resources here as well. Did you want to go over those?
Yeah, as mentioned, I mean, these are all the things I talked about, and if you're interested, if you feel this, you meet the requirements. Anthony, I think, is going to speak in April, actually, so you'll get a lot of him. But there's the Sarasota Economic Development Council if you're in Sarasota County. If you're in Manatee County, there's the Economic Development Council there. So these are the contacts, and you can check with them. With COVID, they have a bunch of programs. I think, although some of the money has run out, but in general, they're promoting business in the county, so they will help you.
Okay, great. Well, thank you so much, Boris. I mean, just really appreciate your time in providing this information. I'm definitely looking forward to our sessions in April that are coming up. Our first one will be on the loan aspect of things. So we'll be covering that in the month of April. We'll be covering angel investing, as well as venture capitalists and crowdfunding, and diving more deeply into that and how to prepare for those kinds of things and what resources you need for that. So looking forward to having you back on the docket again in April. And David, you're very welcome. Just a note to folks, we will be sending out the presentation as well as a video recording of this session. So you'll have access to all the contact information. Just hope that this is really helpful for folks, and be sure to fill out our survey. We always like to know what kinds of workshops are helpful for folks and want to be able to provide that. So thank you. Thanks, Boris. Appreciate your time, hon.
Thanks, everyone.
All right. Take care.